this is a great bull market if you're a long-term investor, but for everybody else, including financial journalists, it's a nightmare, isn't it?
It's just too quiet, too
calm. It's a little weird.
You know, when you have a market that shrugs off what we deem significant news, then by definition, the market is not doing what we'd like it to do, right?
Well, it's funny because I read your piece, and you quoted, you know, it's from the old Western films. You know, the guy's in town, you know, it's quiet here. It seems too quiet.
That's
I think,
right.
you know, and it's like, you know, it's something big is going to happen,
right.
Or what may be the case, and I want to get your reactions, maybe this is it.
Yeah.
Maybe after several years of this outrageous volatility, maybe you're in this kind of slow global economic growth, no big inflation, you know, things just churn it out, and the market grinds higher.
It could be. No, it definitely could be. And I also feel like you see some aspects of that developing, which is, you know, you got these traditional growth stocks, or at least the favored growth stocks, are leading. It's not about just the macro headline of the day, right? So a lot of that stuff plays out. But the one year I can remember that fit that definition in my career was 1995.
Right.
Market went up every day. There was definitely a wall of worry. 94, the bond market crashed. But even in that backdrop that you described, global growth, you know, earnings are pretty good. We have low interest rates. Money's available. Usually the market is a little jumpier than the overall economy. And so that's the thing you have to worry about, because you could have used that a year ago.
Right.
Into March of last year.
Yeah, no, into March of last year. Although it kind of ran up quick, not to be, you know, I don't believe in these comparisons too much, but it ran up quickly and then was kind of flatlined for about 3 months.
Didn't do much of anything until late April.
Here it's been like this.
Right.
I can't do the camera. You know, it's been more on an angle.
Yeah.
But, you know, 3 points, 4 points, S&P 500. I was telling you before we started that, you know, this is the time of the year when I like reallocate.
Right.
And I've been doing kind of, all I hold are mutual funds. I don't trade. But I was kind of selling down my small cap and mid cap funds and some of my growth index fund, because those have done really well, and again into this year. And as I've been selling them, I was like, God, because there's got to be a correction, right? And then I was really thinking today, and I was like, oh yeah, maybe I got the timing right. But it's like a joke. I mean, today the market traded up again. Doesn't really look like it wants to sell off.
No, not immediately. It doesn't. But you know, I guess the only thing I would say is that it always finds an excuse if it gets to that point. And look, professionals have been kind of fighting this move, so it's not as if you feel like people are outwardly giddy. Right. You know, I cite and I look at the investment surveys, but that stuff doesn't necessarily tell you what day-to-day people are doing. And the surveys look like they're at points where you don't want to chase the market higher. You know, they look like, you know, it would likely be a correction.
That's why you have such light volume. It basically is saying there are a lot of cautious people out there who are buying reluctantly at this stage. Not a lot of sellers in the marketplace. So you do have this weird dynamic. Let's talk about anomalies. Let's talk about the bond yields still coming in spite of the market grinding higher. That's not supposed to happen.
It isn't supposed to happen. Obviously, there was this comfortable relationship we got used to. You know, bond yields lower also meant stocks lower. I don't know if it means that we have such utter faith that the Fed is, you know, a persistent, perpetual buyer at the long end of the curve, or what. I don't really know. Or if it's just a recognition of what the Fed has said, 0% for another couple years means that, fine, 2% is my cash substitute. I think there's a significant aspect of that, by the way, where, you know, when cash is like literally at zero, you know, treasuries maybe is considered near cash. Dangerous position, I think, but maybe that's what's going on.
So instead of buying just 6-month paper or 3-month paper, people buy 10-year notes thinking, and so far, getting away with it, that it's like an equivalent. It doesn't really matter.
Well, look, the other thing I would point out is, I mean, the commercial paper market used to be much bigger than it is right now. You used to have these other things that provided, you know, safe yield, and you don't have that anymore.
Right. Now, in your piece, you also brought up the prospect, which it seems like what everybody in the world of financial journalism brings up, which is the specter of higher oil prices, higher gas prices, that eating away at earnings, that eating away at consumer spending. I mean, when you wrote that in your piece last week, did you feel like, God, everybody's saying this. So
Actually, I say it at the risk of pointing out the most obvious thing. And I do think, first of all, I would say we're not at that level where that's all of a sudden going to be the deal breaker. There is a price at which it would matter. But what complicates it to me is that used to be stock market sniffed out a better economy, it went up for a while, and then the energy markets would tighten up maybe down the road a few months or a year, and then you'd have the reaction in the commodity. It moves in lockstep now. So to me, I don't know how to read that exactly. In other words, it was almost like, with oil down 1% this morning, the Dow down almost 1%. It seemed like, well, they were basically doing what they normally do, but then the Dow decided to bounce back. So look, I think it's more likely to be a bolt from the blue if we actually get this kind of a correction. I don't know what that would be. I know too many people are fixated.
Everybody's waiting for the Israelis or something to happen with Iran. I mean, that's basically.
And I actually think the Iranian situation is overplayed in terms of a driver of the market price of oil at this point. I mean, I feel like the smart money that actually trades oil can kind of do the math at Iranian supply, what they really have in terms of military capacity, and all this other stuff, right? So I don't really think that's the thing. I do think it's a risk asset. Credit markets are calm, money is easy, and demand is better for oil.
Final question. Dow 13. I mean, I'm hesitant to ask, but Dow 13,000 today. Come on.
I would say it's a 55-45 yes, just because the market wants to go higher in the afternoon.